picture that I can see for the 2014 results of the banking industry is a continued reshaping of the balance sheet, increased capital ratios. But what we are seeing is with that lower risk appetite is the drag that is having on profitability. And when you then start to dip down into the profitability, there's a piece around actually what is impacting it in the different banks, and it's quite a mixed story in what we're actually seeing. We're seeing costs continue to be a challenge, and each of the banks are at a different stage in their cost optimisation programme. Some are further ahead than others, and we're seeing cost-income ratios which are really quite varied in terms of scale. Some are as low as 51%, some are up at 87%. So that's a big challenge for the banks. And the bigger challenge I see is actually how they sustain, when they reduce the costs, how they keep them at that level. Return on equity continues to be a key challenge, and in fact when you look at each of the banks that we've looked at, none of the returns on equity are above 8%, which in of itself demonstrates to us that actually the banks are not even recovering their cost of capital, which is a challenge for them. What you're seeing is some of the banks coming out now with revised return on equity targets, recognising that the targets of 12-15% in the past are going to be very difficult to achieve. There are positives coming out of the results this year when you look at them. So first of all, you look at the net interest margin, and we've reported in the past about the compressed margins that we've been seeing. It continues to be an area that the banks are focused on and challenged, but in the target markets where the banks are looking to increase their activity, we are starting to see some increase in net interest margin, which is very encouraging. We are seeing loan impairment charges continue to fall, and to fall quite quickly now. And indeed, the level of impaired loans as a percentage of the book is falling as well.
We've been through this incredible period of trying to basically remediate all the problems that have happened, clean up from the financial crisis. This particular moment feels like there's an acceleration away. It's much more about building the banks for the future. How do we look at the whole front-to-back process, make it really work for customers, radically reform our operations? And I think you can see a sense of that coming through the results, a sense of optimism and a moving forward. If you take a step back from that, you can see some of the things that are going to really drive going forward. You have to put the customer absolutely number one. There's absolute commitment amongst all of the top people I talk to move on to a new bank of the future, focused around customer, focused around having the right culture and ethics. All the banks we talk to are really focused now as the remediation charges have started to go down. We're starting finally not to be dealing with all the problems of the past, but think about how do we reform the banks for the future? How do we do much better stuff with customers? And if we're more valuable for customers, our revenues should go up, our profits hopefully should go up. How can we change our operations to make them much more relevant and customer focused and get rid of a lot of inefficiency, old legacy systems? So I think that's what the beginning of the journey that we're seeing.